Good morning. It's the 5th of August, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's rained-out financial capital. The take. Investors everywhere in the world are getting more concerned about market valuations, except perhaps in India. Friday's trade, and we'll come to some details, may have seen some correction, but in general, the Indian markets have been riding high, as you know, along with several markets worldwide, including, of course, the United States, Europe, and Japan. The only difference I can see is that skepticism and concern about the US markets, particularly amongst institutional investors, is seemingly more visible than it is in India. In India, except for a handful of analysts, most feel confident about the current position of our indices and the valuations that drive them. Now, there is no formula to this, nor a predictable reality that something will happen and the markets will go crashing. What usually does happen is periodic corrections, which we've not seen or rarely seen, except that jolt on the 4th of June, the day election results were declared and the BJP government could not command an absolute majority. The Sensex then crashed about 4,000 points to 72,079 on that day, which is now, by the way, exactly 2 months ago. And of course, the markets have more than recovered since then and continued their march to about 81,000 levels today, including, of course, the drop last week. But it is good to be a little more discerning and remember that a massive supply of savings seeking higher returns and perhaps investors who are desperately wanting to fight inflation as opposed to bank deposits which are not giving sufficient lift is driving Indian markets. Now, apart from a younger and hyperactive trading community, which is also buying up small and mid-cap stocks. Now, these are not the only drivers, but strong ones. Elsewhere on Wall Street, several analysts are sounding worried. The chief economist at Apollo Global told The Economist magazine that the bubble was getting bigger and bigger, and that's when you need to worry that everyone will run for the exits at the same time. JP Morgan Chase analyst said that a large number of investors have aggressively crowded into positions based on improbable expectations of earnings growth. Somewhat similar to India, I would think. Goldman Sachs has also said that share prices have risen relative to bonds even as the risks of shocks have grown. Morgan Stanley's chief investment officer told Bloomberg TV and reported in The Economist that a 10% correction is highly likely between now and the US elections, which will happen in November. Bloomberg is reporting separately that after a jam-packed week of earnings reports from mega-cap tech companies, one thing is clear. As profits slow, investors aren't impressed by artificial intelligence promises anymore. They want to see results. Speaking of which, Microsoft, Meta, Amazon, and Apple this week suggested or signaled that the biggest companies in the world are still heavily investing in artificial intelligence. However, stocks of their companies, which is Microsoft and Amazon, fell after their reports because of fears that those AI investments aren't paying off for them, at least not yet. One analyst said that investors are entering a show-me phase, seeking concrete evidence of AI's impact on revenue and productivity. And this, he said, is causing some skepticism and volatility. Now, this, of course, reflects to some extent what is happening in India as well, as several chief technology officers are now questioning whether AI investments are worth it, at least to the extent that they thought they would make much earlier. And things move suddenly. A weaker than anticipated jobs report for July set off worries again that the economy could be falling into a recession. That's the US economy, and reported by CNBC. The Nasdaq Composite lost almost 2.5% to close at about 16,776, and this decline from its recent all-time high is about 10%. The Dow Jones was down about 610 points to finish at about 40,000. And stocks sank in the US after July job growth slowed more than expected, while the unemployment rate rose to the highest since October 2021. And the big one was this. Intel stock price fell 26% in a shock drop, plunging the most apparently in 50 years after it missed earnings and announced a massive restructuring and job reductions. The Nasdaq, by the way, according to CNBC, is the first of the three major benchmarks to enter correction territory, down more than 10% from its record high, as we just said. The S&P and Dow Jones were about 6 and 4% below their all-time highs. Now, all of this is largely investors questioning the tech bubble. And then Warren Buffett appears to have soured on stocks, allowing cash levels at Berkshire Hathaway to touch nearly $277 billion. He's also sold about half its stake in Apple, even as the conglomerate, that's Berkshire Hathaway, which is also an investment firm, posted record quarterly operating profits. All of this is from Reuters. Now, Berkshire's results released on Saturday suggested that Warren Buffett, who's 93 years old and one of the world's most revered investors, is growing wary about the broader US economy or stock market valuations that have gotten too high, says Reuters. Now, among other news that you're surely tracking or watching, at least the Middle East is once again on the boil, with Iran threatening to attack Israel, an action that's being now projected to happen as soon as today, if it does happen. So geopolitical risks, which have been high, are higher now than they've been in a while. So that brings us back to Dalal Street. While the market seems stable and seem that way, all analysts, though in some cases with some prodding, admit that there are parts of the market which are severely overvalued. Valuations and the perception of them are obviously subjective. But the one thing that does happen is that when there are corrections, clearly sectors or sections of the market which are overvalued tend to drop faster. That's one reason why you may have seen investors shift from mid-cap and small-cap stocks to large caps. When I say investors, I mean institutional investors in the last 6 months or so. So the way I would liken it is that the ship of investors is entering a sea with icebergs floating around. You could, of course, avoid them since you have the ability and, of course, the forewarning, but only by staying alert. And that brings us to the top themes of the day. Friday's market tracked global cues, and that could continue on Monday. Oil prices fall to about $77 per barrel despite increased geopolitical risk, thanks to demand woes taking over. India Inc.'s Q1 results analyzed what is looking strong and what is not. And finally, how India's best-known apps in health, travel, and e-commerce are fooling you.
This is a call report with Govindraj Ethiraj.
Here's the market wrap. Weak global cues triggered a sharp fall in the Sensex on Friday, with the BSE Sensex falling about 885 points to 80,982 and the Nifty falling 293 points to 24,717. As is quite evident, the Sensex is below 81,000 and the Nifty is below 25,000 now. Now, for the week since the markets were rising earlier, the Sensex fell about 351 points and the Nifty 117 points. The Reserve Bank of India's Monetary Policy Committee will meet this week to take a call on interest rates, which it mostly will not, that is, to take a call and hold the repo rate around 6.5%, also a sign that all is well, at least in the Reserve Bank of India's view. This week is also seeing several large initial public offers or IPOs coming up. I have no view on these or earlier ones since the price discovery mechanism is highly driven by speculation and thus tough to assess the business on fundamentals. Equally, many of these, as has been the case in the past, have large components of offers for sale, which is essentially investors, recent and old, getting out. So once again, making it tough to assess. There is nothing wrong in investors getting out, but all I'm saying is that makes it tough to assess. I can generally point out, as you well know, that investors have burnt their fingers with tech company IPOs, particularly the large ones, in recent years. Perhaps one question worth asking is, what is that company's present profit after tax position and whether it's carrying accumulated losses? I find several companies not revealing the fact that they are carrying accumulated losses, particularly the so-called new age ones, and finding quite funny ways to hide it. Meanwhile, the rupee slipped to a record low on Friday after stock prices fell in line with a global equity sell-off that we've been talking about. The rupee was down to 83 rupees 75 paise against the US dollar on Friday, its weakest closing level after hitting an all-time low of, again, 83 rupees 75 paise earlier in the session. The numbers sound the same, but the all-time low was a little lower on the fourth and fifth decimals. Oil prices are now hit by low demand. So crude oil prices have fallen to a 7-month low, which is good news for India, as concerns around demand in the United States and China overtook fear of geopolitical risks. Brent crude is now quoting below $77 a barrel, the lowest settlement price since early January, according to Bloomberg. Now, the reason is that both the US and Chinese economies are looking weak, and of course, the latest news that US jobs data is not looking as good as the market expected. Bloomberg said oil's decline was the fourth straight weekly one and the longest one since December, driven by concerns about demand in China, which is the world's biggest crude importer, and the United States, the world's top consumer. State Bank is riding high. So elsewhere, first quarter results are still being released and more on that shortly. Strong loan demand helped the largest lender, State Bank of India, beat estimates at around 17,000 crores for April to June profits, or about $2 billion, though provisions for loan losses also rose sharply, said Reuters, adding that the figure was up about 1% But this was above analysts' forecasts, who were pegging profits at about 16,717 crore. So, all in all, not far from where it landed. State Bank's loans grew about 15%, led by strong demand for retail loans, while deposits grew about 8%. But loan loss provisions or funds set aside for potential bad loans jumped about 70% year on year to about 4,500 crores, said Reuters. In general, of course, Indian banks are reporting strong loan growth in recent quarters, thanks, of course, to higher consumer spending. What are Q1 numbers telling us? So, corporate earnings numbers are a good indicator of how the economy is doing, and there is sufficient granularity to try and assess what the numbers portend as well as for coming months. Note, I did not say they're a complete indicator, but they're a good indicator. At the top level, GDP growth is being driven by a consistent capital expenditure or public spending cycle, says ICICI Securities in a report released last week. According to ICICI Securities, banks and financial services saw stronger performances, while pharmaceuticals, cement, and metal sectors saw misses. The big question, of course, is what are all these numbers telling us about the coming few months or the rest of the year? I spoke with Vinod Karki, equity strategist at ICICI Securities, who looks at factors like electricity demand, which he says now has hit an all-time high, and credit growth, which is around 15 to 16%, to try and assess how things could be in coming months. I began by asking him what stood out for him in the last quarter and, of course, his outlook ahead.
If you observe the GDP trajectory for India, currently Q1 would have expanded around 11% nominal GDP. So any asset class which is expanding demand more than that in terms of profit growth or even the revenue growth, I would bucket them under growth assets. So if you look at from that perspective, what we've seen so far is that sectors which are more on the capital intensive side, the industrials, capital goods, defense, utilities, real estate, even auto to some extent, the whole bank pack basically largely, there we have seen the profit growth to be north of this 11%, which is the GDP line. We think that that's where their demand is outperforming broadly. And the commentary itself, I mean, it's just on the profit growth in terms of order book and the overall situation is looking good. Now, where it is below, but still expanding, that you can see in FMCG, for example. I think the profit growth is around 19%. Same with IT and pharma. So the defensives are growing, but below the GDP line. But there's a bunch of sectors and stocks where there's contraction in profit. Largely the commodity pack, the oil and gas, metals, there's a contraction there. And a bunch of consumption names like apparel, QSRs, paints, movie exhibition, these kind of sectors, we see the contraction in earnings. However, despite the contraction, if you see from commentary perspective and demand perspective, the commodities, be it the cement or cement also contracted. So cement and the energy metals, so the demand is robust, but because of realization issues, there's been a contraction. And so that's the whole picture right now. The aggregate profit being pulled down largely by commodities. The cyclical balance sheet driven companies showing better profit growth relatively. Consumption is mixed between some consumption areas doing well, but others contracting. IT and pharma are in between kind of. So that's how it's looking like in terms of growth.
So let me put a slightly different question, Vinod. So even your report, you've said that strong demand from the capital expenditure cycle is obviously driving the whole thing, as in it's such a powerful force that there is a downstream effect of that. So what if it were not there? And how would this have panned out, let's say, in previous years or other periods?
So there's a distinct change in the color of the economy post-COVID-21, post-FY21. The bulk of the demand surprises we have seen is coming from the investment side of the economy. For pre-21 and starting as back as 12, 13, 14, where the investment cycle peaked out, this was the opposite. All these companies, which I just talked about, industrials, defense, utilities, engineering, real estate, they were a bunch of companies which year by year, quarter by quarter, used to only disappoint. So it's kind of a switch in the economy where the investment side of the economy has started to pick up. we saw similar switch between 2003, 4 to 2000, almost it ended in 2012. In between, there's a blip of the global financial crisis, but the investment cycle peaked out in 2012 and the NPA cycle started creeping in. So I think that's how the thing is. Over the last couple of years, we are seeing these sectors to be doing relatively better.
Okay, so if you were to now look at the earnings of this sample that you've studied or looked at or and are updating, I'm sure, how is earnings looking overall? How is the earnings trend looking? Like, do you see it continuing for coming quarters? And then of the big question, of course, is how does that relate to valuations?
Yeah. So see, like for example, commodities showing contraction, but from an overall demand perspective, you have to remember that if the GDP is on a nominal basis going to expand by around 11%, then there will be sectors which will be above it and there will be sectors which will be below it, right? So I think on an average, and given some leverage effects in the economy, if that starts taking in, I would be disappointed if the top 50 companies in this country don't expand their earnings by 13, 14, 15% at least if the nominal GDP and the productivity of capital also improving in general. ROEs are improving, balance sheets are improving. So, and that's kind of that macro view that I'm taking. When I do a bottom up, I realized that when I add up all these nifty companies, for example, the consensus forecast growth is actually coming around that 14-15% growth. So I think that's the thing. But whatever positivity is there in terms of the GDP revision upwards for India and things like that, I think this clearly more than getting reflected in stock prices. Our market cap to GDP is approaching 150%. It was just north of that, around 155, I guess, the peak we have seen earlier. Nothing saying that earlier peaks cannot be breached, but from a benchmark kind of a thing, it appears to be very close to peak valuation. So I think the reading for the market is simple, that we may enter a phase where stock prices may not rise much, and there could be churn between sectors, some sectors going down while some sectors rising in terms of stock price. And at the index level, nothing much happens for a few quarters maybe. And that gives an opportunity because the earnings expansion is happening at the rate of 14-15%. So for 6 months, if the index doesn't go anywhere, the earnings would have expanded by 6-7%. So that would give you a cushion of valuation.
Right. Last question. So, as you look at the earnings for the last quarter, and we're also obviously begun the subsequent quarter, what are the kind of stocks then you would pick, or rather sectors that you would pick, which you feel would, let's say, allow for good earnings expansion and also have some free room in terms of valuation growth?
Yeah, so that's the question to be asked because, as I said, stocks are reflecting whatever optimism is there. And you're seeing all these sectors which I talked about, the industrials, the utilities, the defense, their valuations. I don't think much is left over there. But if you look at banks, for example, I don't think banks, given that the investors have already taken a leap of faith that the big investment cycle is up. That's why the investors are at such valuations. Somehow they feel that the releveraging of the economy will not happen and banks will not grow at a significant rate going forward. And the valuations are reasonably cheap, in my view, given that the fundamentals of the banks, which is the NPA cycle being at the bottom, and given that the investment cycle is just about picking up, there is no question that at some point releveraging cycle will start in the economy. So they are best placed for the cyclical recovery in the economy, in my view, with less fear of NPA buildup immediately. So that's one spot where I think the growth outlook is great with less chances of balance sheet issues. And the valuations, the key thing is that valuations are not yet too demanding in that space. And it's a large part of the contribution to the profit. So I think that is one space, and maybe some few industrials, maybe in the energy sector, even in metals, maybe where things are a little cheaper, I would say. And the whole cycle has not yet picked up in terms of the industrial pickup completely. So these will be some of the pockets where growth is looking good and valuations are not extremely high.
Okay. So, on the flip side, what are the kind of sectors you feel where there's a considerable mismatch between earnings and valuations, at least in your perspective?
Yeah, so I think consumer names come to mind immediately because there was one expectation from this budget that there will be a lot of populism spending at the cost of development spending, which didn't happen. And if you look at their valuations, they are still in the north of 50s on a forward basis. So I don't think the valuations kind of do justice to the growth and the fundamentals currently. Long-term fundamentals are good for consumer companies in general, but from a medium-term perspective, given that the overall, especially the rural side, the consumption is a little worrisome. I think there's a mismatch over there. Some moderation in valuation will help that to make it better. That's one space. And a lot of these industrials where the growth trajectory is improving, but the valuations have gone really, high. I mean, 40, 50, 60, 70 times basically. I think there you could see some issues over there.
Vinod, thank you so much for joining me.
Thanks for it. Thanks.
How apps are fooling you. A study led by the Advertising Standards Council of India says that 52 of 53 top apps in India, which have been downloaded some 21 billion times, collectively use deceptive patterns. The report or study looked at some 12,000 screens from 53 apps across 9 industries, and it's safe to say that you would know most of them, spanning as they do food, travel, and health. Interestingly, health tech apps were found to have the highest usage of dark patterns, followed by travel booking and fintech. So, what are dark patterns? Well, they are deceptive user interface or user design practices that can mislead or trick people like you and me into doing something that we did not originally intend or want to do. For example, some apps create a sense of false urgency, like in health tech. E-commerce ones made it difficult for users to delete accounts. And basket sneaking, what an interesting term, was seen in delivery and logistics apps. So the 3 big culprits were health tech, travel booking, and e-commerce, says the report authored by Parallel, a Bangalore-based design studio. So I spoke with Manisha Kapoor, CEO of the Advertising Standards Council of India, and I began by asking her what she was taking away, and also more importantly, what was the remedial action going ahead.
This is an area that we have been kind of working on for the last couple of years. We released a discussion paper, we brought out guidelines. The Department of Consumer Affairs also brought out guidelines subsequently in terms of dark patterns. So it's obviously on the regulators' radar, this issue, and even globally it is. I think what we really did not know was the extent of dark patterns. I mean, I think anecdotally, all of us have encountered it. We all know that they exist. Some of them are more apparent than others. And I think the exercise really was to try and map the extent of dark patterns that exist in some of the most popular apps that we use. That was number one. The second thing I think we wanted to do along with that was to also provide alternatives which could be more ethical and did not, in a sense, impair the consumer's ability to make an informed choice. And thirdly, we said, let's also do a score calculator for someone who at least intends to make an app that does not use these dark patterns. Then what could be a way in which we also support people who wish to get it right? So I think these were the kind of triggers more as a follow-up to the guidelines that we had released earlier. And we felt this was the next logical step in that sequence.
So you're saying that there was no specific trigger. For example, the areas that you studied in the report, like travel and logistics or e-commerce in general.
As I said, I think we all have encountered these dark patterns and we know that they exist, right? I think what we really wanted to do was to map how prevalent they were, what were the most prevalent dark patterns, because everything, earlier than that is really anecdotal that we know that they exist. But there was really no study to map the extent of it. And we felt that that was really a starting point to even assess, what is the consumer harm or what is the need for consumer protection and how large is that need. And therefore, it informs and guides us as to what the action should be, how much of a priority should something like this be. So it helps us to take some of those calls in terms of, our action. Of course, inform the industry also about its prevalence and what they could do about it.
Right. So if you look at the kinds of deceptive or patterns or dark patterns, now some are to do with, let's say, influencing your purchase decision, either very overtly or covertly. The second could be to do with collecting data without telling you or asking for more data than perhaps required or making it mandatory in some way. The third could be, let's say, where you are trying to delete an account and you can't. And maybe the fourth could be where, in the case of health tech apps, as shown in your study, you're forcing someone to take a decision base, because obviously there is a certain inbuilt fear in the very nature of this interaction around health. So how are you seeing the hierarchy of, let's say, I mean, I guess it's a reverse hierarchy of the kinds of patterns and their impact on consumers?
So I think, obviously patterns that have an immediate impact in terms of, a monetary purchase that you're making definitely rank high, because you are making a decision immediately and you're kind of putting out some money immediately. You are not very sure whether you made the right decision, or you're not completely confident that the decision you've made is a right one. So that to me is certainly high on hierarchy. I think the second one, which perhaps most of us don't realize what we are doing, is privacy, right? I mean, privacy seems to be a small price to pay for an immediate benefit, but we do not necessarily understand or appreciate the longer term implications of something like that. So to me, that then becomes, in a sense, the secondary kind of issue. The others are also, I would say, come in the way of an enjoyable experience online, right? So, for example, the fact that you cannot delete an account, or it takes you one step to sign in, but 9 steps to log out or to delete an account, or that you are constantly being bombarded, through in-app messages that you may not necessarily wish to see. So that impacts your experience of, browsing and understanding. So some are more directly impacting your purchase decisions. The others could be impacting your privacy and a longer term kind of harm. And the third are just coming in the way of your being able to get on with what you intend to do on the app. So, I mean, that's one way in which we could look at these as well.
Right. And you've looked at all the big names. I mean, you looked at the Uber and Olas and, in travel, Make My Trip, the e-commerce guys. And you're also concluding that purchasing, subscribing, and booking flows are where most deceptive pattern instances were observed. So any examples here?
Yeah. So I think purchasing things like, when you're sneaking something into the basket, which you, let's say, did not sign up for. So that's an example of when you are trying to purchase something, what's happening. Pricing could be another aspect within that you saw a headline price that you got attracted to, and eventually when you check out, that pricing is much higher. Onboarding, again, the data collection that's happening. So those are some of the examples, in this area, which was the area where we saw the most kind of dark patterns being used.
Right. And you also pointed out, for example, the drip pricing, which I thought was an interesting term, that you keep adding. You say the original price, packaging charges, platform fees, tips, taxes, and finally, which we, of course, see in some of the delivery apps, where the final price is almost no relation to what the price of the product is.
Yeah, absolutely. So I think, again, pricing is a very core aspect on which people take decisions, to buy or not. And, therefore, pricing needs to be clear. And there could be some, interfaces or options where some of the services could be optional. And there one could understand that if the price increases as you choose more specific services or, things like that. But if you are actually choosing something which is a mandatory part of the payment, let's assume taxes, so either you upfront say taxes extra, but then if you keep adding taxes as you go along, which is not a discretionary, payment from my end. Whereas let's say delivery, etc., could be, there is a need to maybe calculate distance from where it's being delivered, etc. Or let's say in food delivery apps, I mean, I find things like packing charges. I mean, how will you deliver the food without packing it? So, those then become charges that you end up paying, but you have no choice on not paying those charges. I mean, they are pretty much a part of the offering in the, or they're a very fine part of the offering. So I think those become some of the issues to look at. And what that also does, sometimes it makes price comparison very difficult, right? I'm comparing, price of a certain, let's say, product that I'm buying on site A, where certain costs are included, and then I see a lower price on, app B. But maybe when I check out in the end, I may be actually ending up paying a much higher price. So as a consumer, you are not able to compare prices. I think that's one. I think the third thing interesting about something like pricing is also that I think a lot of consumer studies show that once you actually commit to a purchase, then even as you go along, if you see that it's becoming less and less attractive to you, you have in a sense invested some of your time and effort in coming to that conclusion, and you don't want to start all over again. So I think these are some of the ways in which, we feel that consumers could be harmed, or, there is potential for consumer harm in some of these apps.
Right. So what's the remedial action or move forward? What happens with this? How could consumers potentially either use this, or when, as you showcase this, do you feel the businesses who are involved in, let's say, putting out these apps with these kind of patterns, are they likely to change? Because they'll say that, finally, how do we get customers unless we perhaps hook them somewhere?
I mean, I would say it is a tricky issue because it's not easy to detect dark patterns. That's number one. So, from a remedial action, it may not be that smooth from a regulatory point of view or even from a technology point of view to actually detect some of these dark patterns. So that definitely becomes a challenge. I think the other challenge is that these patterns themselves will evolve over time, right? So even a remedial action that you imagine today will need to catch up with technology as it evolves. So that is then again an effort which is then costly. It needs a certain building of expertise, etc. So if you ask me, is it possible? Of course it is, but it's not easy and it's going to be expensive. And again, therefore, I feel that, with all complex things, it's a mixture of consumer education awareness. It's a question of deploying technology itself to track some of these patterns. But importantly, I think it's also for the industry to realize that in the long term, there will be a pushback against such tactics. And eventually it destroys consumers' confidence and trust in the online experience, which is where all brands are today. And, no one wants that. So I think even in its own self-interest, the industry would need to come along, these journeys and to say that, yes, we believe that, the online experience needs to be something which consumers can confidently come to and feel that it's a space that is safe. So I would say that these are all the different pressures and pulls, which need to come together and work to move to more conscious patterns, to move to designs which are, puts the consumer at the center of, the thinking on that.
Manisha, thank you so much for joining me.
Thank you. Thanks, Gopin.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.